Hope everyone's doing well. This is the Emini review for Tuesday, June 4th, 2024. And looking at the daily chart first, the market has been in a trading range. And this bear bar, the reversal bar, is yesterday. You can see we closed at this price, so the market would likely open somewhere around here. We actually had a small gap down. But the point is we're inside the prior day. So we had an outside day here on the 31st of May, and then another big bar on June 3rd. And now we're opening within those bars, so it's a really tight trading range in here. And I thought that increased the probability that we might have an inside day today. My other thought coming into the day, most bars are breakout bars. They're not necessarily successful breakouts, but most bars break out of the prior bar, either the high or the low, by at least one tick. And because of where yesterday closed, I thought it was more likely we would at least test the high of the prior day. And the overall expectation going into the day is obviously a trading range day. We've had so much overlap and so many trading range days recently. I thought that would continue into today. And then for the 5-minute chart, we had this strong rally into the close of yesterday, Monday, but big down, big up. It's a big pattern, so the swings are pretty big, and this is a pretty impressive bull trend. But the reality is it's big down, big up, big confusion. The market's in a trading range, so this could be high in a trading range. And then we gap down on the open, and the market accepted the gap down. So bar 1 was a bear bar closing near its low. So you can think about the gap down as a bear breakout. So bear breakout and then follow through on bar 1. So some traders might sell the close or sell below bar 1. The problem with selling bar 1, first of all, you look to the left. What happened last time the market was at this price? Let me draw yesterday's high and yesterday's low. What happened the last time we were at this price? We rallied pretty strongly, and this rally was strong enough for a second leg, and we did not yet get a second leg. So if we're in a trading range, this rally could have a deep pullback before getting a second leg. But obviously the gap down and the follow through on bar 1 is so disappointing for the bulls who bought the close of yesterday that they'll probably look to exit at break even. So what the bulls might do, say they bought the close of bar 81, they'll look to buy above a bull bar closing above its midpoint. So they'll buy more, scale in lower, and maybe look to exit at their average price. I'm also going to draw the midpoint of yesterday and look where that is. The similar area here. The midpoint of yesterday, the middle of a trading range. The reason that's significant, two important prices typically generate a third important price. So we have yesterday's high, yesterday's low. The important price between the two is the midpoint, especially when it's a trading range. So bar 1, breaking below the moving average. I said some traders might sell, but one of the problems with selling bar 1 is the location. We're at support, and you have the 20% probability that bar 1 remains the high of the day. It's just unlikely. So for that reason alone, even if we do trigger the sell below bar 1, bears will be quick to exit if they're disappointed. And we did not trigger the sell below bar 1, so any bear who sold the close of bar 1, front running the breakout, got trapped on bar 2. Bar 2 is a bull bar, so big down, big up on the first 2 bars of the day, lots of overlap. It's an inside bar, and that lowers the probability for breakouts. Plus, it's completely below the moving average, so probably sellers above and buyers below. And then another inside bar on bar 3. So you can see on bar 2, we rallied, pulled back on the low of bar 3, and then got a second leg. It's minor on this chart. And then bar 3, being an II pattern, inside bar, II patterns are breakout mode, and the problem with buying here is that this gap down, the breakout was so strong. The odds are there are sellers above. So if you buy here, the upside may be limited. And if there's any disappointment or hesitation by the bulls, they'll be quick to exit. So the bears at this point are expected to get a second leg down. But you can also argue the rally was strong enough for a second leg up. And that's the confusion that comes with trading ranges. Confusion is the hallmark of a trading range. So breakout mode, but probably sellers above and buyers below. Bar 4 triggered the buy above bar 3, but it's a weak bar. It closed above bar 3 and bar 2, and that's good, but it could not close above bar 1. It broke out above bar 1, but sold off into the close. So that's disappointing for the bulls. But 3 bar, really a 4 bar micro channel, so there might be more buyers below bar 4. It's a double top with bar 1, but the signal bar is a bull body, and it's 3 consecutive bull bars. And then bar 5 was another inside bar. So just look at the first 5 bars of the day. They're really sideways. Every bar overlaps another. So that's a warning, and the open of the day, the opening range, usually gives a hint toward what the day will look like. And when you have this much trading range price action, and you've had trading range price action on the daily chart, the higher time frames, the odds are we're going to have another trading range day today. And so, again, with the big down, big up, bar 1, bar 2, and all the overlapping bars today, reduces the probability that today will be a big trend in either direction. Inside bar, bar 5, reduces the probability for breakouts. Probably buyers below, still a weak double top. The signal bar is not great. It's really basically a trading range bar. And after 3 bars up and a micro channel for 5 bars since the low of bar 1, increases the chances that there are buyers below. But weak high 1 above bar 5 and double top, probably sellers above as well. 6 broke out below 5, tested the midpoint of yesterday, and reversed up. Bar 6 is another high 1 signal bar. Bar 5 was an implied high 1. Bar 6 is a technical high 1. You can also call bar 6 a high 2, where maybe bar 3 was a high 1, bar 6 was a high 2. Every double bottom is a high 2. So bar 6 is a double bottom, but if you buy in a stop above bar 6, you're buying a bull bar with a small body, and you're being forced to buy at the top of this tight trading range after the gap down and acceptance on bar 1, the bear bar. So not ideal for bulls. It is breakout mode, tight trading range on the open. Some bulls will buy taking a chance, but they'll be quick to exit on any hesitation. One more thing about the close of bar 6. Leading into bar 7, 10 o'clock bar, Eastern time, there's often a report on that bar, so the market can do something drastic on that bar. And that's what happened today. You can see the market moved pretty significantly. It was the biggest bar of the day. But look what happened on bar 7. You had bulls who bought below bars after this is maybe in theory, or if you're trading the Globex chart, strong enough rally, probably buyers below. So you buy below bar 79, you get trapped on the gap down, and then look where bar 7 tested. Disappointed bulls exiting at break even. I also mentioned earlier, if a bull bought the close of 81 and they bought more above a bull bar, like bar 2, they might exit at their average price, this middle red line, and bar 7 would reach that as well. 7, so 6 and 7, from the low of bar 6 to the high of bar 7, strong enough rally, it'll probably get a second leg. You can argue it's already a second leg from bar 2 to 4, pull back, and then 6 and 7. But 6 and 7 was so big and moved such a big distance that it'll probably find buyers below 7. Plus, do you really want to sell below bar 7? It's a big bar, so big risk, and it has a bull close, 2 consecutive bull bars. Not ideal to sell below. So probably more buyers below. And then bar 8 was a strong bear trend bar. And it is a strong bar, but the context is bad. It's in the middle of a tight trading range, when I just said there's probably more buyers below bar 7. Strong enough up on 6 and 7, it'll probably get a second leg. We are in a trading range, so the market's vacuuming up, vacuuming down. And then bar 8, being a strong bear trend bar in a tight trading range, you have to wonder if it's a sell vacuum test of support and whether there will actually be more buyers on the close of bar 8 than sellers on the close and sellers below. Plus, you're near support. The market tested the midpoint of yesterday once or twice here, and we're getting close there again, but haven't quite broken out yet. And there is no breakout until there's a breakout. Bar 9, a follow-through bar for the bears, but fairly disappointing. It's a trading range bar, and the micro gap. So bar 8 created a micro gap from the low of bar 7. There's a gap from the low of bar 7 to the close of bar 8. But then bar 9 tested the low of bar 7. So any bull who bought here and bought more lower had an opportunity to exit at their original price, their original entry on bar 9. And when you look at bar 9, you can call it a double bottom, but it's obviously not ideal. 2 consecutive bear bars, and big enough down from the high of bar 7 to the low of bar 9 that it'll probably get a second leg. I still think 6 and 7 will get a second leg, and getting a pullback below 6 doesn't necessarily mean they won't get a second leg. Deep pullbacks below 100% are common in trading ranges, and second legs can be delayed. As far as buying above bar 9, 2 consecutive bear bars, weak buy signal bar, the reality is there are probably more sellers above bar 9, and it's forcing you to buy high in a trading range. Look at the moving average, it's totally flat. And again, every bar today has basically overlapped another. So it's really a trading range. So best to buy low and sell high and scalp. And then a trend bar on bar 10, triggering a bad stop order. It was more likely there are sellers above bar 9, and if a bear does sell above bar 9 and scales in higher, they're probably going to make money. If there is a gap from the high of bar 9 into the next bar, bar 11, the gap will probably close because the market is clearly in a trading range. Bar 10 could be the start of a second leg up. So here's leg 1, bar 6 and 7, deep pullback, maybe leg 2. But the problem with bar 10 is that it's a bull trend bar high in a trading range. This is a resistance area, and there were sellers into the close of bar 10. So I think more likely this was strong enough down to get a second leg, and this may be the second leg that the bulls get. And then 11, almost outside down, we triggered the buy above 10 and then reversed down. We got a bear bar closing on its low. And it's a strong bar, but it's similar to bar 8, where the context is bad. It's above support, and the bears really need to do more here. So for now, if anything, this is a low 1 short at the bottom of a trading range, probably more buyers below. Even though it's such a strong looking bar, this is common in trading ranges. You get a rally and they sell. You get a strong bear bar, they buy. Strong bull bar, they sell. So what do you think is going to happen on the next bar? We're going to get a breakout to the downside. It's possible. It's breakout mode. It's possible that we have a head and shoulders top, left shoulder, head, right shoulder. And then a strong sell signal bar in bar 11. But the odds are there are buyers below, and we're low in a trading range. And then 12 could not even trade below 11 before it had vacuumed up. Strong bull trend bar. But you know what I'm going to say. It's what I've just said. Every time there's a strong bar in one direction, like a bull bar, they sell it. Strong bear bar, they buy it. So look at all the overlap. At this point, you could say leg 1, pull back, leg 2, so a second leg trap, high in a trading range, strong bar, but bad context. So it might be more sellers on the close of 12, bulls taking profits and aggressive bears selling. And then disappointing follow through 13. You can call it a low 2, 2 legs up, bar 10 and bar 12, and then a reversal bar 13. 13, some bears might sell below 13 looking for a swing, but bar 12 was strong enough that it might get a second leg. Plus 6 and 7, again strong enough that this may be part of the second leg. And then bar 13 could have been the end of the second leg, but there may be a little more to the upside. So probably more sellers above 13, and selling below is a little aggressive and maybe premature, forcing you to sell on a stop in the middle of a tight trading range, and that's never ideal. So we triggered the sell and found buyers below on 14. 14 is a high 1 signal bar, high in a trading range, probably sellers above, but they may not come in until above 13. 15, another bull bar, but inside bar 13, inside the range of this bar. So 15 only broke out of 14, and it's a relatively small bar. And now you can see this might be 3 pushes up, high in a trading range. You might have more traders selling above 15 or selling the close of 15, selling above 13. The point is maybe leg 1, pull back, leg 2, and leg 2 was 1, 2, 3 pushes up. So maybe a wedge, double top. This is a variation of one of Al's favorite setups. So if there's a bear bar on 16, probably wise to get out of longs below 16. As far as always in today, I haven't mentioned always in because it's a trading range. It's not clearly always in long or always in short. And that's because the market is sideways. So it's buy low, sell high. 16, bear bar. So if you were long, probably wise to get out below 16. Bears can sell below 16 for a possible swing of the day. Because of the reasons I just said, it's a possible double top and then a wedge here. And then a decent sell signal bar on 16. And then after 3 pushes up, the pattern's minor. It was only made of about 6 or 7 bars. So the correction, you're expecting 2 legs sideways to down. But because the pattern is minor, it might not be 10 bars and 2 legs. It might only be a couple of bars. But I do think we're going lower. I think 16 was enough of a surprise that we'll get at least a second leg down. And then bears selling for a swing, they can sell below 16, stop above maybe 13, maybe the high of the day, and they might just hold short until there's a reason to exit. Those are the always in swing bears. 17 triggered the sell below 16, not an ideal entry bar, but if you think about the opposite side of the trade, do you really want to buy above 17 if you're a bull? Probably not. You just had 2 legs up, 1, pull back 2, and again the second leg was a wedge. And now you're getting a high 1, high in the trading range. And this obviously is the trading range, so we're probably going more sideways to down here. So okay for bears to hold on to shorts, and probably sellers above 17. 18, a little bit of a surprise. It's a strong bear bar, but you have to wonder if it's a sell vacuum test of support. We're at the bottom of the trading range, and we're in an area where every time we've tested it all day today and even the end of yesterday that we found buyers here. It's right at this red line, the midpoint of yesterday. So the bears need follow through. It's still a minor breakout. We're still within the range of the trading range. The bears really need to get a breakout below bar 9 and well below bar 9. And even if they do, you have to wonder if 57 is the bottom of a bigger trading range, because the market, if you think about the market cycle, we had a bull breakout here, a pullback. Pullback is the start of the channel, and channels evolve into trading ranges. So bull channel here, but it might be evolving into a trading range, and this might be the start of the trading range, the low of the trading range. So this price may be significant as well. start of the channel, possible low of the trading range. So we might go a little lower, but the bear still needs to do more. As far as selling here, it's not ideal. You're selling low in a trading range after a sell climax, a pause, and then another sell climax. So you might have exhausted bears who sold higher, taking profits in this area. And then you have aggressive bulls buying in this area, which is reasonable to do because every time you bought the 50% of yesterday's range, you made money. And then disappointing follow through 19. So if you did sell the close of 18, you might be quick to exit after seeing your entry bar 19. As far as buying above 19, I would not. We are low in a trading range, but the momentum down is too strong to look to buy. The first reversal will probably fail, so probably sellers above 19. And if I didn't mention it, 16 through 18, strong enough bear breakout, and micro channel since 15. So 15 to 19, a bear micro channel, strong enough that it'll probably get a second leg. So sellers above. The sellers may not come in directly above 19. We may go and test the moving average. We may also test the 50% pullback of the breakout, which is around here. So I will also draw a line. I don't want to get the chart too crowded, but I think that's also an important price. So 50% pullback level here. This is the 50% of yesterday. And then up here, yesterday's high. This is the start of the channel, possible bottom of the trading range. And down here is yesterday's low. So 19, probably sellers above. Strong enough down, it'll probably get a second leg, but still not ideal to sell down here, the bottom of a trading range. So strong bears, probably not selling here. Breakout to the downside, but failed on 20. But again, on 20, do you really want to buy above bar 20 after a couple dojis, after a fairly strong breakout to the downside? I say that. What I mean is, it's not really a strong breakout. We're still within the trading range. But you know this is strong enough that it'll probably get some sort of second leg. And you have to ask yourself, is bar 20 the second leg? Probably not. This could all be one leg. Some traders will argue, maybe down here, from 7 to bar 9 was leg 1, pullback, leg 2. Even if that's the case, still the odds are there's sellers above. So as far as buying above 20, I would not. I think there's probably more sellers above. And like I said, the 50% pullback level is what I would be most interested in because this is a breakout within a trading range. So rather than being aggressive and selling low, because what do you do in a trading range? You buy low and you sell high. Now we may not come all the way back up here, but selling the 50% pullback is better than selling the close low in a range. One more thing, selling the 30% pullback, it looks like bar 19 tested 30% and got a small second leg. So some traders did scalp there. They set a limit order at 30% to sell. They get triggered on 19. They scalp out with, let's see, about 6 points. But at least traders made 5 points if they sold 30% and put their limit order 5 points below. Low 121, but again, we're still low in a trading range. The bears have not done enough. The market's gone sideways for 3 bars. So strong enough breakout for a second leg, but now we're going sideways. The most common thing after a sell climax or a buy climax, a climax in either direction, the most common outcome is 1 to 3 bars sideways. Now we've had 3 bars sideways. The market's going to decide, we're going to break out to the downside, or is this a low 1, low in a trading range with buyers below? That's probably more likely. And then instead of trading below 21, traders bought the close of 21. They know it's a low in a trading range, and low ones, low in trading ranges, are not ideal to sell. So instead, traders will buy it. 22, a good bull bar, but at the top of a 4-bar trading range. And possible, it's a good looking bull trend bar, but when you get a trend bar, every trend bar you have to ask, is it a vacuum test of some support or resistance level? So is bar 22 racing up to, is there momentum? Are bulls excited to buy? Or is it a vacuum test of resistance like the moving average and maybe the 50% pullback level? So decent bull bar 22, but still below the moving average. Still haven't had a second leg down for the bears. Leg 1 pullback, probably sellers above. 23, we tested the 50% pullback level and found sellers. So bulls, if you bought 22 or if you were waiting for follow through on 23, you're probably disappointed. There might be buyers below 23 after a micro channel since bar 20. 4-bar micro channel, but a doji and a bear bar 2021. The only strong bull bar is 22, and it's completely below the moving average. So as far as looking for a second leg here, it's really risky, and it would be minor at best. So if anything, it looks like bears sold the 50% pullback, and they're looking for leg 1 pullback, leg 2. And then bear trend bar 24, probably going at least a little lower. If a bull bought below 23, they're trapped. 24 has some support to the left. That's still a problem. Lots of overlapping bars, possible low in a trading range here. But leg 1, we could easily get a symmetrical second leg. Something like leg 1, pull back, leg 2. It takes us close to the start of the channel yesterday, which could be the bottom of the trading range. So we'll just look at this level. But there's obviously a couple magnets below. The bulls are hoping 24 gets bad follow through and we get a double bottom, maybe a wedge, 1, 2, maybe 3, and then an early low of the day and a swing setup. We're still on the short below bar 16. The bears really haven't had a reason to get out. You could say it's a second reversal above bar 22. Maybe you exit, but if you did exit, you can short again below 23 or 24. And then follow through selling on 25. So bulls hoping for the double bottom, obviously not getting it. We're getting a downside breakout on 25. The first breakout of all the bars to the left. And so traders want to see follow through on 26. And another target the bears might look for is a measured move of this bear flag. That measured move is here, still around the area of the start of the channel. Strong enough down, probably going at least a little bit lower. The bulls don't have a credible buy setup yet, probably sellers above 25. 26 was a bull reversal bar. We're finding support at the 60-minute moving average. The dotted blue line is the 20-bar EMA on the 60-minute chart, plotted on the 5-minute chart here. And to do that, you can add a study, you can add an exponential moving average that traces back 221 bars. And that can be significant support or resistance. You can see in this case, the 5-minute EMA and the 60 EMA are relatively flat and close together. And that's just telling you the market's in a trading range. We've had bars below, over here, below the 5-minute, below the 60, then above, and then coming back below the 5-minute, testing the 60. So obviously just going more sideways than anything else. And now at this point, the bulls are maybe arguing that we have a wedge bottom. You can draw it a couple of different ways, maybe 1, 2, 3. Maybe it's a double bottom, breakout of a double bottom. Every breakout of a double bottom that reverses can be considered a wedge, even if it doesn't have the shape of a wedge. So a couple different ways to draw. Failed breakout to the downside. Decent signal bar, 26, but strong enough down. 4-bar micro channel since 23. The first reversal attempt will probably fail, so bulls might be looking for a second reversal to buy. 26 is more likely profit taking by the bears. Plus, if you were a bear, or if you were a bull, you bought below bar 20, the low of the trading range. You got trapped on 25.26, but 26 immediately came back to your entry price. So the bears are not all that strong. 27 triggered the stop order above 26, but we weren't really expecting much out of that stop order trade. There were more sellers above. Now 27 is a low 1, but the breakout isn't very strong. Possible wedge bottom. There might be more buyers below 27. But again, this sell-off, 23 to 26, was strong enough for a second leg down. Outside bar, 28. Outside bars are trading range bars, expanding triangles on smaller time frames, more clearly seen on maybe a 1-minute chart or 30-second chart. Probably sellers above and buyers below. One thing that's actually interesting regarding expanding triangles, look at today. We had a couple pushes up, 1, 2, 3 legs up, and then bar 9 broke. Did it break below bar 1? 77, 75. So this is a double bottom. But bar 1, then we broke out to a new low on bar 20, and then another new low, 26. Market may not be perfect, but it's some sort of expanding triangle pattern. I have a lot of lines drawn on the chart, so I'm going to delete them. But keep that in mind, that the market may have an expanding triangle here. I also forgot to mention, by bar 18, there's an 80% chance we've seen the high or the low of the day. So at this point, probably more likely we've seen the high of the day based on where the market is. But if you think more deeply about it, you think about the day structure, you think about the higher time frame context, and what I just said about expanding triangles, it actually may be more likely we'll form a low of the day fairly soon, and then get a reversal that trades above the high of the day. But for now, maybe 50% chance we've seen the high of the day, and hard to tell until we get more information. Inside bar, 29, so IOI, breakout mode. Possible final flag for the bears, so even if we get a breakout to the downside, maybe the last one before maybe reversal out. As far as buying above 29, some traders might, but there's not great buying pressure. In the past, however many bars, maybe 12 bars, we've had 1 or 2 decent bull bars, so the bulls probably need to do more. And then 30, bear trend bar, but not breaking out to a new low, so still higher than the low of bar 26. This is a tight trading range. IOI, like I said, possible final flag. So leg 1, pull back, leg 2. Really, you could call it 3 legs down. Maybe 1, 2, maybe 3. You can also say bar 9 was leg 1, 26 leg 2, maybe a leg 3 here. A couple of different ways to draw it. As far as selling 30, I would not, because we have several different supports drawn below, like the channel line here, possible wedge bottoms, the 60-minute EMA, and even if we go down here, there's probably buyers below. And then we got a reversal bar, 31. Disappointing for the bears. Now a second reversal, so bulls didn't want to buy above 26, and then we got another breakout, and then a failed breakout, 31, reversing up. Bears might exit above 31, and aggressive bulls might buy above 31. It's not the greatest bar. The bulls might want to buy later with more certainty, with higher probability. Right now it's a 40% trade, Some bulls might buy above 31, hoping it's the low of the day, going for a swing. Like I said, maybe going for a new high of the day, maybe going for yesterday's high, but low probability trade for now. And we did not trigger the buy, so instead we got an inside bar, 32. As far as selling, 32, it's an inside bar and possible wedge bottom on the expanding triangle bear channel line. So again, a couple of different ways to draw support. Not ideal to be selling. Plus, it's an inside bar with prominent tails below. The odds are there's buyers below. Even if we break out to the downside, the breakout will probably pull back within a few bars, if not immediately. And as far as it's an inside bar, so as far as selling above, I would not. I think buying below is okay, but selling above could be risky because we could be forming some sort of bottom here. 33, another inside bar, so II pattern, which is breakout mode, and it's an II pattern, a breakout mode pattern within a wedge bottom. So 1, 2, 3 legs down. The third leg, you could say, subdivided into a wedge of its own, 28, 31, and 32. 3 pushes down, several ways to draw it, expanding triangle support, 60 EMA support. The bears are holding below the moving average, that's good, but look at the past maybe 8 bars. We've had more dojis and bull bars than bear bars. We've had one decent bear bar since 25, but the selling pressure has been weak. And again, the day structure, is it more likely this weak bear channel continues all day? I've said this before. This is what Al says. Bear channel, you can think of it as a bull flag. 75% chance we get a bull breakout of a bear channel, and this bear channel is weak. And you can see it looks more like a wedge, and we've had a strong rally that didn't get a second leg. Maybe this is leg 1, pull back, leg 2, and we're forming a major bottom here. Bears probably exit shorts above 33, and always in bulls can buy above 33 for a swing. It's a credible stop order trade, but the probability is still low. 40% at best. Small signal bar, small risk, and big reward means low probability, but not unreasonable. So again, I think always in bears, probably exit above 33 and wait. 34, bull doji bar. So not the best entry bar if you're a bull. But the counter of that, 34 is a low 1 short at support at a possible bottom. So as far as selling below 34, that's not ideal either. There's probably more buyers below 34. 35, another bull bar. So a 3 bar or a 4 bar, maybe even a 5 bar micro channel since 31, trending lows. It's subtle, but the bulls are controlling. They're getting equal or higher lows over the past 5 bars. They're getting time control. The bulls have controlled 4 of the past 5 bars. And they're seeing the expanding triangle. They're saying, we've tested the top. We've tested the bottom a couple times. We're going to go back and test the top. 35, a bull bar. Closing on its high. That's good for the bulls. Some bulls might buy above it, looking for a swing. But again, the probability is still not high. The risk is small. The reward is big, and that means you have bad probability. And whenever you have small signal bars like 33, there's an increased chance the market will do something to trap you out. So if you have a stop below 33, the market could easily form some sort of bar that trades below 33, maybe even below 32, trapping out the weak stops, only to reverse back up. 36, bull surprise. Good bull breakout. It's actually interesting. I was watching an Ali Afshari video earlier this morning, and he was talking about something like this, where the market's going down in a bear channel. We're below the moving average, but suddenly the bulls get 1, 2, 3, 4, 5 bars with getting higher lows. and it's subtle. The bars are not very big, they're overlapping, but at some point, the algorithms, they're going to see, at this point, there was not really much of a threat for a major reversal. And even here, small bull bar 33, there's probably sellers above. And then you sell above 33, not a great entry bar. And then you get another bull bar 35. So at some point, the algorithms conclude we sold above, but we're not going down. And eventually you get a give up bar. That's what 36 is. 36 is a give up bar. And that's bears giving up, getting out of shorts. And then you have bulls looking for the major reversal, who are also buying. The breakout, technically, micro channels since 31, but you could say the bull breakout started at 33. Either way, strong enough for at least a second leg up. Probably buyers below. 36 is a strong bull bar too, crossing the moving average and closing near its high. It might be always in long. You had a bull bar closing on its high, 35, and then 36, another big bull bar closing near its high. But look where 36 closed, right at the 50% range of yesterday's daily range. And so there might be resistance, and we might pause at that price. And that's what 37 is, a pause bar. High 1. In this context, I think it's okay to look to get long here, looking for a major reversal, strong enough leg up. You know there's probably more buyers below. 38 traded below 37, which was a low 1, and a weak signal bar, bad context, so there were buyers below. But now we've gone sideways for a couple bars. Some bulls might still buy above 38, betting it's a high 1 early in the market cycle. Bull breakout, looking for a second leg up. And then 39, another surprise. Pretty big bull breakout bar, closing near its high. Probably going at least a little bit higher. You have to remember the market's been in a trading range, so you look to the left, and this bar, 23, might be resistance. You can see where 39 found resistance, maybe some profit taken by the bulls. But when you look at this rally, it's kind of similar to the sell-off. You don't want to buy immediately after the sell-off, even if you are low in a trading range. So here, pretty strong rally. Not ideal, even if you're high in a trading range, not ideal to just blindly sell. And then follow through 40. So bull breakout 39, follow through 40. Not the greatest follow through, it's a smaller bar, tail above. But it did close above 39, and that's good. So is this leg 1, pullback, leg 2? Technically, yes, we had a pullback on bar 38. But it was brief, it was one bar, didn't go very deep. And actually, if you measure it, probably about 30%. So this red line here is 30%. We dripped maybe to 40% before we got a rally. A little bit higher. So it's technically 2 legs up. But if you go even to a 10-minute chart, you know this is probably just a couple big bull bars. And from 33 to 40 is all just one big bull breakout. So this all could be leg 1, and then we could get a pullback, and then leg 2. Always in long, probably going at least a little bit higher, buyers below. 41, a bear bar, getting a deep pullback. You can see where we're testing, where the market hesitated. You had bears selling above 38, betting it's a high 1, high in a trading range, where bulls got trapped. And then those bears got trapped on 39 and 40. Those bears scale in higher, and then they get a chance to exit on 41, and that's what they do. And that is what produces the tail on the bottom of bar 41. 41 is a bad stop order signal bar. It's a high 1, but a bear body and fairly high. Traders would rather buy a pullback, and this will probably get a more complex pullback. Probably sellers above bar 41. 42, a small inside bar, so lowers the probability for breakouts. The range is getting smaller, it's compressing, probably going more sideways, but still always in long. Okay to be long. and probably buyers below. And then 43 traded below 42. At this point, we've had 2 legs down, 41, pullback, 43, and a higher low. We're getting a bull trend line from 38 to 41 and 43. Support at the moving average. We broke above the midpoint of yesterday, and we're bouncing at the midpoint of yesterday and maybe becoming support. Bears are sold there. Like I said, they got trapped, and they're using these sell-offs to get out of their losing shorts. And bulls who didn't buy are using these sell-offs to enter during the pullbacks. Strong enough up, like I said, it's probably all just one leg, and this pullback will probably lead to a second leg up. 44, a bear bar, but 2 legs down, 1 pullback, 2. 44 could not close below the low of 43 or 41 here, and that's not ideal. It's also maybe a 50% pullback of the bull breakout, and that's a common support area. Actually, it's a little bit deeper. It's closer to 70%, and bulls will buy until the market gets to about 70%. The odds are still greater we're going to get a second leg. If we keep pulling back, the odds increase, but the odds become more about 50-50 that we get a bull breakout or a bear breakout. But for now, still more bullish, still always in long. Bears probably need at least one more bar. And when the bears need one more bar, bulls will take that as a reason to buy, and they buy the close of 44. 45, a bull trend bar closing on its high. It reminds me of over here, when you're in a bull channel and it's always in long, look at every single bear trend bar. Bear trend bar gets bought. Trend bar gets bought again and again. And that's what's happening here on 44. The bears need at least one more bar to convince everyone we're getting the reversal, we're always in short, and they can't get it. Now 45, technically a high 1. We have a micro channel from bar 40 all the way down to 44. We're finally getting the breakout above the micro channel on 45. So that lowers the probability of buying here. However, you can see it's 1 pullback, 2. So 2 legs down. So as far as betting on the bear micro channel, when you dissect the bear micro channel, it starts with a bull bar. And then there's 3 bear closes, but 2 of them close above their midpoint. And then you have a bull bar in here. So really not the strongest bear micro channel in the world. It's also coming off a major reversal, a strong breakout, so it's counter to the always in direction. You can say it's counter to the market regime. So a couple of reasons why selling here, you might get a second leg down, but the probability is lower and it's a little more risky. It's easier to make money trading the always in direction. I think bears can exit above 45 if they're short, and always in bulls, if they exited for any reason, they get long again above 45. Bull bar 46 closing on its high. Good entry bar. The breakout succeeded. Closed above the stop order entry price. Still within this trading range, but the trading range lasted about 5 bars. It's a minor pullback. So leg 1, pullback, maybe the start of a second leg here. Again, easier to see on a higher time frame, but this breakout may come all the way up here and test close to the close of yesterday. Most bears are not going to sell above a bull bar closing on its high, especially consecutive bull bars in this context, always in long, expecting a second leg up. So probably going at least a little bit higher here. Disappointing bar, 47, but minor bar. Bears, they can argue lower high double top. Bar 40 was the first reversal, and then a double top, second reversal, 47. But it's a small bar after 2 decent bull bars. And again, the context is bad. So best case, maybe 40% the bears sell. They go for a measured move down, all the way down to here. More likely, there's buyers below. The bulls are looking for the opposite measured move and for some sort of double bottom, maybe 38 and 44, and then projected up, goes to just above the close of yesterday. And then outside up 48. So bear trap. If you did sell 47 and it hesitated, bears were quick to exit. We tested the moving average and reversed up pretty strongly on 48. Another bull bar closing on its high, probably going at least a little higher. What about nested 2 legs up? Leg 1, pullback 1, pullback 2, the second leg up. One of the problems I have is that it's not symmetrical. Here's leg 1. A leg 2 measured move would come at least to here, testing the high of the trading range from earlier. Plus, we've had 3 of the past 4 bars, bull bars, closing on or near their highs. So really not ideal. The selling pressure is not great in here. We've had 1 or 2 bear bars. This bear bar closed below its midpoint. This one did too, but it's small. Really not ideal to be looking to sell. The bulls are controlling bars above the moving average. We might have a spike in channel. 49, big bear bar triggering above 48 and then reversing back down, closing near its low. So it was 2 legs up, 1 pullback 2, and then 1 pullback 2. So bears will say 49, that's the second reversal. 47 was weak, 49 is stronger, but the bears still need to do more. They have a decent signal bar, 49, and now they need a good entry bar. Otherwise, this is still a minor pullback, and we're in a bull channel where sell-offs get bought, and then disappointing follow-through for the bears on bar 50. It's a high one. You might have traders buying above, disappointed bears exiting shorts, and bulls buying to get long. Still always in long. Still probably going at least a little bit higher. 51 triggered the stop order above 50. Tested the close of 48. Didn't quite get there. We had bulls who bought 48. They got trapped. They got a small second leg. And then 51 reversed down. They sold out of their longs. Bears sold somewhere up here for a scalp. But they did just that. They sold for a scalp. 49 was strong enough for a second leg, and 51 could be that second leg. We could go a little lower and trade below 51, but I think more likely there's buyers below. We've been above the moving average completely for the past 3 bars, really the past maybe 5 of 6 bars, and all these bars are mostly above the moving average. We're still always in long. The bears are hoping to get a major trend reversal here, and they might, but it's 40%, and 51, the reality is it's a doji bar, and that's a trading range bar. There's probably buyers below. 52, an inside bar, probably buyers below. There might be sellers above, but if you're selling against the always in direction. 53, another bull bar closing near its high. Micro channel since bar 50, probably buyers below. There were disappointed bulls on 48. Traders are wondering how they'll react once they get back to their price, as we did on 53. Will the next bar, will they continue to buy? Will they exit their longs and we'll go more sideways? It looks like bulls were disappointed. The market might be in a trading range. At this point, the bears C3 pushes up, but 54 is a weak sell signal bar. It's also a bad buy signal bar, so probably sellers above 54. But again, it's a counter to the market regime. It's a bull channel. Again, it might be a wedge top high in the trading range. Traders will respect that. But the selling pressure in here could be stronger. This breakout, strong enough for a second leg. This could all be part of the pullback. And again, we may get a measured move of the breakout, which could be all the way up here. $55, another bull bar closing near its high. So look at all the bull bars in here. Many of them close near their high. And for the bears, only a couple, maybe 1, 2, 3 of them close near their lows, but 2 of them are more trading range bars than trend bars. And for the bulls, a lot more bull bars, a lot more bars closing near their highs, and control above the moving average in a bull channel, probably going at least a little higher. So this could be one of those places where we have a possible wedge top, but we get the measured move up. And that's a similar measured move as the spike measured move here. Then you have yesterday's close, a magnet, yesterday's high. You have the expanding triangle bull channel line. So magnets above. The bears are not getting a sell setup. Sideways on 56, an inside bar. So you could argue sellers above and buyers below. And that's true. It's a contracting range. Market's in breakout mode. But because we're always in long, and because of the context, I think it's more likely we got the breakout to the upside. 57, we're getting the breakout. 57's an okay bar, but tails above and below. And micro channel since 54, but 54 and 56 are not bull bars. And so this could be stronger for the bulls, but pretty tight channel, since you can say all the way down here, depending on how you draw it. So tight bull channel, in general, you only want to look to buy. So your choices here are to be long or flat. And then bull breakout 58, obviously going higher. What about, is this an exhaustion gap? I don't know. It could be, but there's a lot of space between the bars to the left, and 58's closing above many bars to the left. If you had a choice here, would you rather sell the close of 58 and go for a move back down here, or buy the close and go for a move up here? I think it's more likely, maybe 60%, we're going for a measured move up before down. 56 and 57 might be give-up bars, where the bears were trying to create a wedge top, but they couldn't get enough selling pressure. Not enough bears would join them in selling. Not enough bulls would exit their longs. Because for always in long bulls, where do you exit? You might exit below 49, but then you can buy again right after bar 50. And then through here, there's no reason to exit. And then obviously a strong bull breakout. At some point, the risk gets too big for the bulls. So stop below 57, you're long on 59. Your stop is all the way down here. But when your stop is far and there's strong momentum, your probability is high. That's the trade-off for high probability. You have bad risk reward. Your stop is really far away. And at some point, the bulls need to reduce their risk. One way to do that is they reduce their position sizes and they take profits. So at some point, we're going to find profit taking. So when the market stalls and we get maybe sideways doji bars and profit taking, more and more traders may look to exit. So at this point for the bulls, probably exit below a bear bar, closing below its midpoint. This is a parabolic move, but the breakout is strong. The bars are getting stronger, and uniform size bars, 58, 59, little overlap. We have a tick gap from the close of bar 57 to the open of 58, and the close of 58 to the open of 59. You have trending closes. 57 closed above the bars to the left. 58 closed above the prior bar. 59 closed above the prior bar. Every low is above the prior low. And since bar 57 through 59, the bars do not have big lower tails. And they don't have big upper tails either. So bulls are buying right up into the close of the bar. There's no significant tail above the bar like on bar 7. Also in this bull breakout, this sequence of bull bars, there's no dojis or opposite bars. All of that is to say this is a strong breakout, and we're probably going at least a little bit higher. 60 overlapped bar 59, really 100%. 60s might almost be an inside bar, and that might be enough of the momentum waning for the bulls to look to take profits. High one above 60, but it might be late in a bull trend. We've gone up for about 30 bars. Whenever you've been in a trend for over 20 bars, it's true, these breakouts can be exhaustion gaps. And look where we're going. We have a couple magnets a little higher, the high of yesterday, and the expanding triangle bull channel line. And this could be a vacuum test of resistance and not the start of another bull trend. So for bar 60, as far as selling, I would not sell. The only selling I would do is to exit longs. And then 61, there's your bear bar closing below its midpoint, far above the moving average and late in a bull trend, and possibly high in an overall trading range environment. So that's a bar that bulls can exit longs below. Obviously strong enough up, it'll probably get a second leg. Inside bar 62, high one buy, but this high one was early in the market cycle. This might be late. We've had one pullback, two legs up, and when you look to the left, more easy to see here on the daily chart, but we're high in a trading range. And there's probably sellers at yesterday's high, a bad signal bar. And so as far as this high one, it's smaller than the bear bar. The context is bad. Probably sellers above, bulls taking profits above. Aggressive bears might sell, but for me, not enough selling pressure here to be looking to sell yet. 63 a bull bar, but sideways for the past 4 or 5 bars. Now we're high in the range. Might be more sellers above. 64 a doji, so disappointing breakout bar for the bulls. Micro double top with bar 61 and 64, but 3 bar micro channel, maybe 4 bar. Really, actually, there hasn't been a pullback since 54, so this is all micro channel, but obviously getting high in the range. Bulls, they have a windfall of profit here, and at this point, probably wise to take profits, and more likely we start going more sideways. 65, finally breaking below a bar to the left. A bear reversal bar, a second reversal, technically the first one, but another bear bar that bulls will look to exit longs below. Still always in long, but we might be starting to go more sideways. 66, a bear breakout, breaking below several bars to the left, but still within 60, probably in a trading range here. Maybe 2 legs down, 1 pullback 2, but this was strong enough for its own second leg. Now, one of the problems, this breakup was strong enough, there's probably buyers somewhere below, but this may get a second leg. And then 67, another give up bar. 67, always in short. I don't know. We had big up, 57 through 59 or 60. Big up and then big down. So in general, I'm thinking trading range. So as far as always in short here, it might be, but it might be briefly always in short. And when it's always in short in the trading range, it's time to buy. So here, probably buyers below 57 at the start of the breakout. As far as buying straight below 57 with this much momentum, I think most traders will not. They'll look for more sideways, maybe a second reversal to buy. But bears, if they sold below 65, they have a windfall of profits and they'll look to take profits here, probably going more sideways. Disappointing bar for the bears on 68, but 68's unlikely to reverse this bear leg. It'll probably get a second leg first. The first reversal up will probably fail. 69 triggered, the high one, and now 69 is a low one short, but bad context at support. Buyers below 57, and there were, and now 69. A couple of bull closes and bad context for a low one. Probably more sideways, might be low in a trading range, probably buyers below. Same with 70, we did not trigger below 69, so 70 becomes a low one. Maybe 3 pushes up, 68, 69, 70. It's a minor reversal, wedge bear flag, maybe a quick second leg, but I'm expecting more sideways here. And if we do get below 68, I'm expecting buyers below. 71 continuing higher, micro channel since 68, increases the chances that there's buyers below. But still, a minor reversal. This is clearly much stronger than this. This is a channel on a lower time frame. Big tails and lots of overlap. Bull channel is bear flag. 72, a disappointing bar for the bulls. A trading range bar, but still a micro channel. Still probably buyers below. Bears, they might have sold a close of 67. They got trapped. That's a magnet. I had to pause there for a couple minutes, so I forget where I left off, but the point I was making is you had bears selling the close of 67, trapped on the move up here, 68 through 72. Now this will probably get a second leg down, and it hasn't yet. Pull back to the moving average. It's a bull channel, so a bear flag. On a lower time frame, it's more clear. The tail's up. The overlap is a more clear channel. And I think if we do test the close of 67, you'll have bears disappointed, and they'll look to buy. And then this breakout from the low of 68 to the high of 72, that was strong enough for its own second leg. So any pullback would probably get a second leg as well. So a couple of reasons to find buyers at this level. Go ahead and delete the midpoint of yesterday. And then obviously it depends on how you draw it. At this point it's more obvious. You can just draw the expanding triangle like that. Looks well behaved. 73 traded below 72. Low one, but micro channel, so there were buyers below. But now 73 is a high one. Bad context, sellers above. Big bar, so big risk. Probably sellers above, sellers on the close, getting a second leg down. And that's what happened on 74. And then you can see we tested the close of 67, that red line, and then we bounced. 3 legs down, it's a micro wedge. 72, 73, 74. And then a double bottom with over here. So this might get a bounce and a second leg up. Clearly bears were disappointed. They bought back shorts. But 74 is a bad signal bar for stop orders. And then a surprise bar, 75. Whenever the market does something surprising, that's a leg count reset. So 75 is strong enough for its own second leg. There were not supposed to be buyers above a weak signal bar like 74. But we got this strong bar. I think the odds in general, surprise bars are leg ones, but here it could be leg one, pullback, leg two, high in a trading range, or getting high in a trading range. So increased chance that 75 is a leg two trap. Leg two traps often look stronger than the first leg. And then no surprise, there's bad follow through on 76. But 76, obviously the market's going more sideways. It closed breakout points. Bears who sold above 72, trapped, scaling higher. They get a chance to make a profit on 76. 76, so 75, still strong enough for a second leg, but it could be minor, and 76 is a bad high one, sellers above, and probably going more sideways into the close here. 77 could be the bulls' second leg. It could also be 3 pushes up, 1, 2, 3. But a bad stop order sell signal bar below 77. At best, we'll probably just find buyers below and go sideways. Inside bar 78, probably sellers above, buyers below. Obviously getting really late in the day, not really worth looking for trades here. And then 79 broke out to the downside, but immediately pulled back. And then it's a weak stop order for the bulls. Really stop Weak stop order for both sides. Sellers above, buyers below. Inside bar 80, same thing, but obviously late in the day, not time to do anything, but probably sellers above and buyers below. And then a bull bar 81 to close it off. For always in today, with the gap down and the follow through on bar 1, it might have been always in short after bar 1, but it wasn't clear considering the context with the prior day. So maybe always in short, but not clear. So also might be a trading range. Big up, big down, big confusion. And all through here, market's really sideways, not clearly always in long or short. Maybe always in short 18. We had 3 consecutive bear bars and a big enough breakout for a second leg, and then a possible high of the day and swing short below 16, and we're on the swing sell below 16 all the way through here. So probably always in short through here, but eventually you get 3 pushes down, and then you get 33 and inside bar breakout mode. So always in. Bears can exit shorts, and aggressive bulls can buy for a swing. And then if they do, no reason to exit all the way through here. I think the market became always in long on bar 36, crossing the moving average, at least one big bar closing near its high, but consecutive bull bars closing near their highs. And then as far as exiting for the bulls, I don't think you have to exit until maybe below 47, but you know it's probably minor. And then you get 49. That's a bar that I think bulls can exit below. But if you do exit, you can buy again above a bull bar, closing above its midpoint, like bar 50. And then through here, no reason for the bulls to exit. Here, windfall of profits. At some point, the risk gets too big. Bulls are probably looking to take profits somewhere around here, and they might do it here. But still always in long. And then a first reversal, always in bulls get out below a bear bar, closing near its low. And then a second reversal, they certainly get out below 65. That's what happened here. I mentioned this earlier, probably not always in short here, or maybe briefly, especially on a smaller time frame. But on this time frame, big up, big down, big confusion. It's a trading range. So buy low, sell high, and scalp. Right now, we're low, so if anything, better to look to buy. And trading range for the rest of the day, not clearly always in long or always in short. Stop orders today. Bar 6, well actually, bar 5 might have been the first reasonable stop order trade. Micro double top, bar 1 and bar 5, or bar 4. After the gap down, looking for a double top, maybe a measured move down. But traders were quickly disappointed on 6. And then 6, possible stop order buy, but probably minor. It's really high in a trading range. And the signal bar isn't great. The context isn't great either. All through here, it's a limit order market, so I thought the next best stop order trade was below 16. Possible wedge top, wedge double top, and a decent signal bar. If you did sell, really no reason to get out until down here. And I don't know, maybe you can sell below 24. 24 is a bar where if it's always in short, you can sell below any bar, closing below its midpoint. So you can sell below 24, 25, but obviously not ideal when it's a possible wedge on 25. Same with 30, the same problem, possible wedge, not ideal. And then 33 was a reasonable buy. And then you could buy above 34, 35, betting that the always in is flipping here. We're getting a major trend reversal. 36, I thought you could buy the close, buy above. 38, high 1, early after a strong breakout, probably buyers above. And then 39, 40, also probably buy the close, but now it's 2 legs up, probably expect a deeper pullback. 45, high 2, 1, pullback 2, strong signal bar, decent stop order trade above 45 for a swing. And all through here, you can buy above any bull bar, closing above its midpoint. Buy the close here, But again, as soon as the momentum fades, bulls are looking to exit. And then a second reversal below 65. Crazy as it sounds, after such a strong rally, I think always in bulls exit below 65. And that's reason enough for aggressive bears to sell below 65. I thought it was too aggressive to buy above 68, but a second reversal would be okay. It came on bar 74, which was a weak stop order signal bar, so okay if you missed that trade. Plus it was late in the day. That's about it for stop order trades. And then for limit order trades, trading range on the open, overlapping bars, sellers above bar 1, micro channel, buyers below bar 4. I thought sellers above 6, a bad high 1. Obviously, we went well above 6 before the sellers came in. And then I thought buyers below 7, expecting a second leg up, and a bad sell signal bar, big risk, and bull close. And then all through here, you get a bear breakout, traders buy the close, bull breakout, they sell the close, all through here. Bad high 1, bar 14, sellers above. 16 was an exception. I said you could sell below 16. I wouldn't buy below 16 for the reasons I mentioned earlier in the video. 21 was a low one. You could buy below. You could buy the close for a scalp, and that's what happened here. Although the context was bad, so actually I didn't mention you could probably sell below 23. It was not a good limit order trade when you're expecting a second leg down. And then through here, you expected 26 to be minor, so sellers above, and there were. Tight trading range, probably buyers below 26, and there were. Through here, first reversal after this breakout would fail, so buyers below 37. Same with here, you can buy below 40 and scale in lower. 42, low 1 after a strong breakout, probably buyers below, and all through here. This was a minor double bottom or double top and a small signal bar, probably buyers below 47. I thought it was respectable to exit longs below 49, but traders obviously bought the close. It was similar to that channel yesterday. Wherever there was a bear bar, they bought. And over here, we're in a bull channel, bear bar, they buy. And buyers below these bars, nothing to sell. Bad sell signal bar 53, they bought. Micro channel, so odds are the first reversal will fail. But because of the context, that's why I didn't think it was wise to buy below these bars. Through here, I mentioned buyers below this rally with disappointed bears below, and they came in on 74. And then trading range in here, sellers above 76. And probably buyers below, but we didn't quite get there. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And I hope everyone has a good rest of their night. Thanks for watching.